Hey guys, it's Nick. Today, after the close, Alphabet, or Google as most people know it, posted their fourth quarter earnings results and they beat estimates across most major metrics. And the company also announced a 20-for-1 stock split. In this video, I'm going to look at how good the earnings were and then talk about the stock split, what a 20-for-1 stock split means, and if it is good or bad for the stock. I'm also going to look at possible reasons they're doing this now, like trying to get added to the Dow Jones Industrial Average. So let's look at the earnings. Google had net income of $20.6 billion or $30.69 a share in the fourth quarter, compared to net income of only $15.2 billion or $22.30 a share in the same quarter last year. And their revenue after removing their traffic acquisition costs was $61.9 billion compared to $46.43 billion in the year ago period. Overall, the revenue jumped 32% to $75.3 billion. And this is a lot better than the analysts' estimated net income of about $27.68 a share and their ex-traffic acquisition cost of $59.25 billion. Also, their operating profit margin improved 29% in the quarter versus 28% in the same quarter a year ago. And of that, search was $43.3 billion versus $31.9 billion a year ago. And YouTube ad sales continue to outperform, jumping $8.6 billion from $6.9 billion a year ago. And YouTube recently hit 5 trillion all-time views, and a few hundred of those views are actually from my channel. What's pretty important here in their earnings is that their Google Cloud revenue jumped 45% to $5.5 billion, which is a pretty big jump, even though they still trail Amazon and Microsoft in cloud revenue. And the CEO of Google said that the fourth quarter saw ongoing strong growth in our advertising business, which helped millions of businesses thrive and find new customers, a quarterly sales record for our Pixel phones despite supply constraints, and our cloud business continuing to grow strongly. So Google stock is up to over $3,000, or up 9% in the after hours after those earnings. And just about 8 trading days ago, Google stock was as low as right about under $2,500, and now at $3,000. That is a 20% jump from the bottom to now in just 8 trading days. That is a big move for a $2 trillion company. As you see here, about a year ago in February, Google was about $2,000, and it took until May to get up to $2,400, or a 20% gain. So it took February, March, April, 3 months to get there, what Google just did in 8 trading days recently. So guys, kudos to you if you were bold enough to buy the dip anywhere around $2,500 a week or so ago. You're looking at gains of like 20%. Now, about the split, the CFO of Google said, the reason for the split is it makes our shares more accessible, Ruth Porat, the CFO, said in a conference call with television anchors. We thought it made sense to do. So the split still has to get voted on at the next annual meeting, but once it's approved, it will come at the close of business all the way at July 15th. So it's a long way off. So what is a 20-for-1 split, and is it good for investors? Well, the objective answer is that a split has absolutely no effect on the shares you own. So it is not positive or negative. So think of it like this. If you owned 1 share of Google and it was $20 a share, all this split does is exchange this 1 share for 20 $1 bills. So when you go to McDonald's and ask them to exchange a 20 for 20 singles, do you get any more or any less money out of that exchange? No, because it's exactly the same thing. So the only difference, though, is that Google is not $20 a share. It's about $3,000 a share. So if you were holding a share of Google, when the stock split happens, Google will now give you 20 shares, but the stock price will be $150. It will be 1/20th of wherever the stock is trading when the split happens. So you don't get any more money or less money in the real world. But since we don't always live in the real world and people don't always act rationally, a stock split is usually pretty positive because it makes the stock seem cheaper and more accessible to smaller investors. Now, this was more true in the past, but with many brokerages today offering fractional share investing, investors can invest even just a few dollars into Google stock, whether it is $3,000 a share or $150 a share. Now, there are two different stock symbols for Google, GOOG and GOOGL. Now, the last time Google split was in 2014, and it was more of a vehicle to create a new class of stock that did not have voting rights. So the founders wanted to maintain control, and so they made three types of shares: an A class, a B class, and a C class. So the three types of shares are the Class A shares, which have voting rights and trade under the symbol GOOGL. Then there are the B shares, which are super voting shares and have 10 times the voting rights of the A class shares. But the B class shares do not trade publicly, and they're owned by insiders and co-founders like Larry Page and Sergey Brin. And then you have the C shares, which have no voting rights, and it trades under the symbol GOOG, which is the one that probably most people watching this video are going to buy. So why is Google splitting now? Well, maybe it's because they want to get added to the Dow Jones Industrial Average Index, and possibly they may want to get there before Amazon splits its stock and possibly gets added first. So why do they have to split their stock to get added to the Dow index? Well, because the index is weighted based on the stock price, not on its market cap. So a $3,000 stock price will mean that Google has an oversized weight in the Dow. And let's take a look at the current Dow components and their weighting. So there's 30 stocks in the Dow Jones Index, and the most expensive one is United Health Group Incorporated, UNH, and their weighting is 8.86%, and their stock price is $468. So if Google got added at $3,000 a share, their weighting would be about 6 times higher, or what's that, 50% of the Dow index at the $3,000 price. And so the price goes down from there, and you see there's a lot of stocks around the 150, 160, 200. So that's probably where Google would fit in, somewhere around there. And it would be kicking out some of these kind of dead weight kind of stocks, like maybe Intel or Cisco or IBM. My guess is it would probably be IBM or maybe Cisco. So all this good news in Google may really convince more people that the worst is over in the NASDAQ, at least until the next inflation report. So guys, does the good Google earnings or the news of the stock split make you want to buy Google shares now? Let me know in the comments below. I hope you liked this video, and I'll see you in the next one. Thanks for watching, guys.